What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we are going to be checking out Abercrombie and Fitch because the stock is down 18% today. And it's all that happened was that they came out and they raised their guidance for Q4, right? Changed it to 7 to 8%. So you think the stock would go up, right? But it says Wall Street had already expected the retailer to top its guidance, and analysts were already expecting 7.5%. So it makes absolutely no sense why the stock is down 18%. I don't know if they were maybe expecting them to. I mean, it says Wall Street was expecting 7.5%. So it's really exactly what they were expecting. It makes no sense why the stock is down 18%, but it is what it is. Now, I have never owned this stock. I thought this company became kind of, I don't want to say irrelevant, but they were popular 20 years ago, 15 years ago, and then maybe, 10 years ago, I thought they were going out of style when I was in high school, right? And it looked like, I mean, I think they were suffering a little bit at some point, but something happened in 2023 where the stock went from, 20 bucks right here to $130 today. And I mean, it was even higher. It was even $186. So this market cap now is $6.6 billion dollars. And honestly, I was impressed with their growth numbers right now because you look at 15% revenue growth expected this year. It's at least they're growing. But look at the EPS jump, 6.5 to $10.5 and then $11. So the numbers are strong here. The valuations that look bad, I guess they were just trading really cheap. They were probably just the revenue and their numbers were probably getting worse during this time because the price to sales was, a zero point 0.4. But now it looks way more expensive at a 1.7, which it is, but 1.7 is not a lot. That's not very expensive. So, and then you go and you look at their, like even on a PE basis, it's really not that bad. And you look at their numbers, I mean, the last couple of years they've been growing revenue, right? Like it was pretty flat right here again when the stock was trading down. But look at the past couple of quarters, they've been very strong here, and we're looking at $4.8 billion of revenue. Then we go to their net income, same thing. I mean, look at just 2 years ago, they barely made any money, and now they're doing $530 million, which is very good for a $6 billion company, really. I mean, a free cash flow yield of 8.5%, you never see that. And I would say the cash to debt ratio is not great. It's pretty much 50-50, so it's not great. Return on capital, some of these numbers, like even these ROI numbers right here, these are not bad at all. These are here, let's zoom into the last couple years here. And I mean, yeah, these are on a quarterly basis, 8.5%. That's pretty good. Then we have margins of 10.5, 11%. So that's still not bad, especially for a retailer. That's better than a lot of them. Shares outstanding, not bad at all. So, I mean, it's not a company I would want to own really because again, they can go out of style, and I don't see a super strong moat or anything. It's not like other companies I think that are better investments out there. But I am shocked that it dropped 18% today. And really, the numbers don't look too bad. So if you're a shareholder, I don't think, I mean, it's not horrible. The valuation is not that high, and their growth is not that bad. So that's all I have to say about this stock. Thank you for watching, and I will see you guys in the next video. Let me know if there is any other stocks you want me to do.